Good afternoon and welcome back to the Talking Trusts information sessions. This is part 3 of our 4-part series where we host guest speakers who are experts in trust law and taxation and who will share practical information and insights aimed at helping you navigate your duties and responsibilities of being a trustee. I am Ricardo Teixeira, Chief Operating Officer at BDO Wealth Advisors, and I will be your host and facilitator for the Talking Trusts information sessions. Thank you for joining the conversation today. And if you are joining the Talking Trust series for the first time, please do look up the recordings of part 1 and 2, which you can find on BDO's YouTube channel by searching Talking Trusts. Today's webinar will also be recorded, and a link to the recording will be shared with you after the event. We have set aside a 10-minute session for an interactive question and answer session following the talk. So please line up your questions in the queue during the talk by using the Q&A function, which you will find on your screen. It is on the top right-hand corner of your screen. Look for the speech boxes with a question mark. BDO has been providing professional audit and advisory services to families and businesses for over 60 years in South Africa. And there has most certainly always been a focus on trusts. However, of late, both SARS and the Master of the High Court appear to have raised the stakes and their attention to the governance and administration of trusts. Trusts are unique structures, and as a result, this attention by SARS and the Master of the High Court has unfortunately revealed many shortcomings and failures by trustees, many of which have had devastating consequences on the original purpose and intent in establishing a trust. So with tax reporting season around the corner, BDO's objective in hosting this information series is to raise your awareness, knowledge, and understanding of the best practice and benchmarks for good governance in the administration of a trust. By knowing what is required and having the right solutions and processes in place, a trust can be extremely beneficial to a family's wealth creation and protection. Today's topic is tax planning opportunities for trusts. At face value, it may seem to be a contradiction to use opportunities and tax in the same sentence. Our previous talk on Trust Tax 101 highlighted the onerous tax obligations for trusts and trustees. Trusts are not tax-saving vehicles. However, knowing how to structure a trust's affairs and transactions can most certainly bring tax opportunities to beneficiaries and donors alike. Structure can be all the difference between a punitive tax and an advantageous tax position. So whether it's establishing a new trust or structuring the affairs and transactions of an existing trust, knowing the tax considerations can be very useful in achieving the best outcome in the long term. Today's speaker is well qualified and experienced to tackle the complexities of tax opportunities and considerations. He is partner of BDO South Africa and specializes in individual and corporate tax consulting. He has more than 20 years experience in the taxation of corporations, trusts and individuals on a wide variety of domestic and international issues, and consults to large listed and unlisted entities. He is an adjunct associate professor in taxation at University of Cape Town, chair of the South African Institute of Chartered Accountants National Tax Committee, and he has also recently accepted an appointment as member of the Tax Court in the Western Cape. Please welcome Professor David Ornica.
Thanks, Ricardo, and welcome everyone. It's very nice to be part of this presentation on trust, and trusts are very topical. They always have been insofar as taxpayers are concerned. And I think that the remark that Ricardo made just now is very on point, and that is that although we're talking here about tax planning opportunities for trusts, I think it's very important to realize that trusts are not predominantly meant to be, and they in fact aren't really in reality around for tax saving purposes. The main reason for having a trust must be something other than tax, because really the opportunities are fairly limited, and you'll see what I mean by that just now when we start going through the content and we start looking at some examples. Often it's a question rather than of tax planning, of a choice between the lesser of two evils insofar as the consequences are concerned. So that's, I think it's got to be seen in that context. So we're going to, just on the agenda that's up there, I'm going to speak very briefly just now, come back to it, on opportunities due to the low values that have been created by the COVID-19 pandemic. We're then going to have a look at some examples of how trust taxation actually works. And we're going to look at an example where assets are donated into a trust. By contrast, there's going to be the sale of assets to a trust on interest-free loan account. We're going to look at capital gains that then arise when the trust then disposes of those assets and how those are taxed. And then we're going to move on to this question about interest on loans to trusts. Should it be charged? Should it not be charged? And we're also going to then end off with considerations around the structuring of affairs with regard to foreign trusts. So I think it is very important for trustees to have some understanding of how trusts are actually taxed, and the more understanding one has, the better informed decisions and choices can then be made in this area. So just coming back to the first point that I mentioned about opportunities due to low values created by the pandemic, as I mentioned, the primary reason for forming a trust should not be tax. There are lots of other good reasons for it, and tax would certainly, in my way of knowing a lot about trust taxation as I do, would be quite low on my list for forming trusts. They're very valuable vehicles in terms of continuity of one's estate and planning around the administration of the estate, but not really for tax. But if one is looking at forming a trust now and moving assets in, now is not necessarily a bad time to do it. If you look at the value of shares, of listed shares, at the height of the pandemic, compared to that point, the values have gone up substantially, in fact, at around about the pre-COVID-19 levels. But there are certainly cases where there might be shares that are struggling. Companies are struggling and the share values might still be depressed and be low. We've also got a scenario around the world of quite low interest rates, very, very low interest rates, in fact. And so when it comes to attribution and thinking about whether one should be charging interest at market-related rates and so forth, then the market-related rates around the world are actually quite low at the moment. So one can think of, moving assets in. We've of course got fixed property that you might be thinking of moving that in. With a fixed property, one often thinks it's probably better to start off with the property in the trust, because to move it in South African property anyway, there'd be an additional leg of transfer duty to be paid, depending on how one structures it. But if we could move on to the next slide, and then we'll be looking specific. We're going to get into the examples that we've got in a moment or two. Firstly, I just thought I'd set out the different sections of the Income Tax Act that we're going to be at least looking at in our examples this afternoon. These are the main ones that deal with the taxation of trusts. So we've got Section 7 that we're going to be spending a bit of time looking at, that really deals with attribution rules. So where income that typically would land up being taxed in the hands of somebody else, maybe the trust or a non-resident beneficiary or a minor beneficiary, in terms of Section 7, that income is attributed back to the donor that has created either donated assets into the trust, or has got a lower than market value related interest loan in the trust. We're going to also be considering Section 7C, which is a fairly recent section that has been introduced to try and cater for the sort of deferral of estate duty situation. So it's sort of a proxy for estate duty, and the proxy in this case has been deemed to be a rate of interest on the loan that one uses to introduce assets into a trust. So there's a deemed donation based on the amount of interest that kind of should have been charged if interest had been charged based on the official rate of interest. So we'll come back to 7C. Section 31, which is our transfer pricing provision in the Act that deals mainly with foreign trusts. So when we come back to foreign trusts, we'll be thinking about that. And then Section 25B is the main sort of core provision in the Income Tax Act that determines how trusts and beneficiaries are taxed. And then we've got the Section 7 attribution rules. I've got sort of mirror images relating to CGT in the 8th schedule, those attribution rules which are in part 10 of the 8th schedule. And then we've got the basic CGT core provision, which is to be found in para 80. So quite a lot of provisions. And I must say that the taxation of trusts is really particularly complex. There are a number of unanswered questions with regard to which provision might take precedence over the other. That also tends to make it quite complicated. So it's very important in any situation to get proper advice. So I think if we could move on then to our case study. So the case study here is if we think about a family discretionary sort of standard trust situation, a resident trust, South African tax resident. We've got a family that are the discretionary beneficiaries of that trust. We've got a husband who is in this case, is the one that introduces assets into the trust. We've got the wife. We've got a major child who's resident, and we've got a major child who's non-resident. And so the transaction here is that the husband donates shares into the trust at market value, of which we have assumed to be 1.2 million rand. And for CGT purposes, we've assumed that those shares have got a base cost in his hands of 1 million rand. What happens then is the shares then reside in the trust, as the trust owns them, and the trust then receives South African dividend income of 100,000 rand, let's say, for this year that we're considering. So with regard to dividend income from a South African company, that dividend would generally be subject to South African dividends withholding tax at the standard rate of 20%. And I'm not going to come back to that point in our examples. So that dividends tax will be suffered. In the case where if there's a dividend that becomes vested in a non-resident person, so in this example, it's the major child, before the end of the tax year, then if that major child lives in a jurisdiction that's got a double tax agreement with South Africa, that dividends tax may be subject potentially to a lower withholding rate than 20%. There's some paperwork and administration required in order to achieve that. I'm not going to go into all of that now, but just to note that there are some cases where the rate might be less, and most notably if it is a non-resident in whom that dividend is vested before the end of 28th of February by that trust. So I think if we could move on, hopefully everyone can just remember that scenario that we've got. And now we're going to have a look at what the tax considerations are around that scenario. So firstly, let's just consider donations tax. So because there was a donation, out and out donation of those shares into the trust, donations tax would be payable, and donations tax is leviable on the market value of the assets that are donated. So there's the market value 1.2 million. There's an annual exemption from donations tax of 100,000 rand that the husband may be able to use, and I say may be able to use because the 100,000 annual exemption actually is intended to cover every single gift that the person makes, other than specific ones that are already exempt in terms of donations tax legislation. So your standard, Christmas presents and birthday gifts and things like that. So if you use your 100,000 Rand in one go or in one tranche like this, is the argument that then every other gift you bought for anybody during the year basically should be subject to donations tax. But anyway, let's assume this was the only gift that was made during the year. So then the donation would be, the donations tax of 20% would be worked out on the 1.1 million. In other words, donations tax of 220,000 would be payable. Donations tax is payable by the end of the month after the donation takes effect. So if this was donated, let's say in the middle of March of the first year, donations tax would be payable by the end of April. That would have to be settled to SARS. If we move on and consider the income tax considerations themselves, so we've got capital gains tax. Now, although the husband was actually donating this asset, so in other words, one wouldn't think that there were any real proceeds, there weren't any. There are still deemed proceeds in terms of the 8th schedule if an asset is donated. And the deemed proceeds are market value. So once again, we're back to the 1.2 million market value. Capital gains tax, you get the base cost, which can be subtracted from the market value to work out the capital gain. And also there's an annual exclusion of 40,000 Rand per natural person per tax year. So once again, if the annual exclusion hadn't all been used up, or at least partly used up, then the 40,000 would be available here too. And the maximum effective rate of CGT is 18% for a natural person. So it's a lot lower than the 45% maximum income tax rate. So maximum rate is 18. So if it was 18, if the person was, in other words, the husband was already on the maximum income tax rate of 45%, the 18 would apply, and it would then be 160,000 that would apply to, and 28,800 would actually be the CGT. And then if we have a look at what now happens with regards to the income tax on the dividend income. So we've got two scenarios here for you. If we just move on to the next slide. So remember what happened was that the trust received a dividend income of 100,000 Rand per annum. And the question is now, what does the trust decide to do with it? The trust could retain that dividend income and not distribute it, or vest it, I should rather more technically correct, in the hands of the beneficiaries. In which case there's one tax treatment, but if the dividend is vested equally in the beneficiaries, there's another tax treatment that would apply. So if the dividend is retained in the trust and it's not vested in the beneficiaries, then one of those attribution rules that I spoke about in the beginning would say that, well, because there was a donation that's resulted in this dividend income accruing, the person that made that donation, in other words, the husband, is then subject to any income tax that, or rather is subject to any income would have to be attributed back to him in his hands, and he would be subject to tax if there is tax to pay. So that is section 7.5 that we've set out on that slide. So that would apply here because the 100,000 of dividend income arose because of the husband's donation. So the husband would then be subject to tax if there is any tax. Because it so happens that we're dealing with South African dividends here, there's no income tax payable on dividends because they're exempt from income tax in terms of 101K1 that we've put there. So no income tax is actually payable. If it had been some other type of income, let's say it had been, a property producing rental income, for example, that rental income, less all the attributable deductions, would then land up as being included under the husband's income for income tax purposes. On the other hand, if the dividend is vested equally in the beneficiary, so in other words, what we're assuming here is that the trust before the end of February, on or before the end of February, the end of the tax year, makes a decision, a resolution of the trustees that they are going to vest that income equally in their in the beneficiaries, then what happens is basically, and if we could just go back, I think, to the previous slide, please, that the dividend income would then be sort of taxed where it goes to. So in other words, in this case, 100,000 over 4, 25,000 goes to each beneficiary physically. Each residence beneficiary in this example would be subject to tax in their own right on the 25,000 because the income has gone out of the trust. But because it's a South African dividend, no tax is payable. It's fully exempt. With regard to the non-resident, there is one of those attribution provisions, section 7.8, says that income that accrues to a non-resident is dragged back to the donor. So the donor, the husband, would then be subject to any tax that there might be insofar as child number 2 is concerned. But in respect of child 1, the husband himself that would have received the 25,000 and the wife, there's no deeming provision that applies where the income is actually distributed out of the trust by the end of the year and is vested in the beneficiaries. Okay, so those are the scenarios with that case study. If we could move on to the next case study, please. What this case study is basically concerned with is really the sale of the assets now by the trust. So let's say the trust has got those shares and the dividends have accrued for a few years. And let's say that, very important, the trust holds those shares not for speculation. In other words, it holds them as capital assets in its own right. So we're looking potentially at capital gains tax that could apply rather than revenue tax. The question now is, if it now sells those assets let's say to a third party at market value, 1.5 million in a few years' time, the base cost would be 1.2 million. What are the consequences? Okay, so the base cost in the hands of the trust takes over the deemed market value that the husband was taxed on as its base cost in the shares. So it's not taxed on the full 1.5 million market value. Fortunately, gets the sort of uplifted base cost when it acquired those shares from the donor. And and it's obviously the same scenario, so we've got the same beneficiaries and so forth. The question is, what are the income tax consequences? So if we could just move on to that. Looking at what the income tax consequences are, we've once again got the two scenarios. Either that capital gain can be retained in the trust and not distributed or vested in the beneficiaries, or it can be vested in the beneficiaries. So if it is retained in the trust and it's not vested in the beneficiaries, then as we had with the situation with the dividends where that happened, the donor, the husband, is attributed all of those capital gains for income tax purposes. So para 70 of the 8th schedule is the provision that achieves that. And what would then happen would be that the full 300,000 would be subject to capital gains tax essentially in the donor's hands. There would be a 40,000 Rand annual exclusion that applies every year to a natural person that would be there again, once again, if it hadn't been already utilized. And once again, 18% maximum rate that could apply to the net difference, so 300 minus the 40,000 annual exclusion. So that's if the gain is retained in the trust. On the other hand, if the gain is distributed or vested Equally in the beneficiaries, once again, before the end of the tax year, very important that resolution must be done before then. If you want to do this, you want this to be the case. Then what would happen would be that basically the capital gain is taxed where it goes, essentially, except for in the case of the non-resident beneficiary, who once again, that 75,000 of capital gain is dragged back and taxed in the hands of the donor, the husband. Once again, each one of those parties would be able to avail themselves of a 40,000 Rand annual exclusion. So you can see this sort of splitting does achieve, you get the 40,000 that is then, if you split the income, attributable to each one separately rather than just the donor, if the donor had retained it. And then also those beneficiaries might be on a lower tax rate than the donor, so it might make sense to then distribute it. If you're only considering tax, of course, there's much more at stake here. There's the actual amounts going and who you want the amounts to end up with, etc., is also very important and should be the overriding consideration with regard to making these sort of decisions. Then if we just move on to case study 3. So case study 3 is, by contrast, the sale of assets to the trust on interest-free loan account. So if we've now got the sale of the assets, let's say instead of a donation, the husband actually sells them to the trust on interest-free loan. The loan would then have an amount owing, unless it's repaid and so forth, of 1.2 million Rand. Same case as before with the beneficiaries, etc. I think if we can just move on. If we then consider what the income tax considerations are with regards to the sale on interest-free loan account, exactly the same with regard to capital gains tax. So we don't really need to spend time on that. We can move on. Same as in the first case study. The capital gains tax is identical. Once again, there's a disposal at 1.2 million. There's the base cost of 1 million. Moving on to the next slide. Now, there's no actual donation taking place because the shares are actually being sold at full market value, so that's not a donation. But Section 7C of the Income Tax Act introduces a deemed donation. So to the extent that there's interest is not charged on the loan at all, or the interest is less than what's termed the official rate of interest, which is an income tax defined rate of interest, then there's a deemed to be a donation taking place in the amount of the shortfall in interest. So there's an annual donation that takes place every year at the donations tax rate at 20% on the deemed interest that sort of should have been charged, which is determined as being the official rate. Now, the official rate is relatively low. At the moment, it's 3.75% if it's a Rand denominated loan. And so, as I say, it's relatively low. You can also take the 100,000 Rand annual donations tax exemption off in calculating your actual donations tax that's payable, which is then subject to this 20% annual ongoing donations tax amount. The donations tax has to be paid by the last day of March. So just to note that it doesn't give you much time, but between the end of February and the end of March to pay it. If we could move on to the next slide. So with regards to the income tax consequences, there's a slight difference here in that there wasn't an out-and-out donation. So the gratuitousness here is actually the non-charging of interest, and it's limited only to the extent to which a less than market-related rate of interest was actually charged on the loan. So those deeming provisions that we looked at, Section 7 and Part 10 of the 8th Schedule, they will only apply insofar as the non-charging of interest is concerned. So there's a limit, in other words, to the amount of attribution that one does back to the donor, a monetary limit. You determine that based on the shortfall between the interest that's charged, in this case none, and an arm's length rate of interest that should have been charged if the parties had been at arm's length and contracting on that basis. So to the extent that of the husband's liberality, that one would attribute income or capital gains back to him. That's the contrast between the two. And if we move on and we just consider whether one should charge or not charge interest on loans. So if you didn't, so what we're saying is, let's say that we're taking a situation where it's not the out and out donation, but we're now looking at, so we could actually have an interest-free loan if we sold assets or loaned money into the trust for the trust to buy its own assets. We could charge interest on that loan, which would then get us out of 7C if we charged at the appropriate rate, and it would get us out of the attribution, right? Whereas if we didn't charge interest on the loan, we would have Section 7C and we would have attribution to the extent of the shortfall in interest. Should we charge, shouldn't we charge? What are the considerations around that? So if we're considering charging interest possibly at a market-related rate, maybe at least equal to the official rate, so that neither the deeming provisions or the 7C would apply. Just remember, if we did charge interest, if the husband had actually charged interest, he would have been taxable on that interest at his maximum rate, or whatever rate he's on, his marginal rate, which could go up to the maximum rate of 45%. So that's quite high. He would be able to set off the annual interest exemption, which is pretty low, 23,800 per annum against that interest. Once again, if he didn't have a whole lot of other interest that he was already allocating that against. On the other hand, it's not a zero-sum game necessarily, because the interest he's taxed on may well not be deductible by the trust. For example, in our example here, where it was dividend income that was produced, dividend income is exempt, therefore the trust wouldn't be able to deduct that interest income. So he's taxed on the interest, the trust can't deduct it. Also, if there were unproductive assets that were in the trust, like vacant land and stuff like that, also no deduction of the interest. By contrast, the rate of the 7C deemed donation is actually only 20% per annum. It's relatively low. You can use the 100,000 annual donations tax exemption against your 7C deemed donation. And, you know, as I mentioned earlier, Section 7C will not apply if at least the official rate of interest is charged. But by contrast, 7C and Part 10, what determines whether they apply is whether interest of at least an arm's length rate is charged. So there's a difference between the official rate and what an arm's length rate would be, which can lead you to, you know, having Section 7C apply and then partly not Section 7 and Part 10, or vice versa. So the calculations get quite complicated with regard to, you know, if one isn't charging at the greater of. What one does see in practice largely is that people tend not to charge interest on the loans, but it's not a hard and fast rule, and it does depend on the individual's circumstances. And then lastly, just some considerations around a foreign trust. So, you know, if you're considering offshore structuring, I think the very most critical thing really at the start is get the tax residence right. So if what a lot of people think is actually a foreign trust, for tax purposes might well not be a foreign trust. Because generally speaking, unless the place of effective management is in the foreign jurisdiction, it's not an offshore trust from a South African tax perspective. So critical to get that right. What's meant by place of effective management? It's the place where the key commercial and management decisions regarding the overall affairs of the trust are in substance made. Well, that's a bit of a mouthful, but what it really means is the important critical decisions made by the trustees must be made, if it's going to be an offshore trust, other than in South Africa. Okay, so generally it goes down to where the trustees' meetings are held, but not necessarily only that, because you can get a dominant trustee who overrides everybody else, or you can get a donor, or you can get a protector that kind of is making all the decisions in substance, and the trustees are just rubber stamping. So there's a lot of consideration needs to be given to that. But then we've got a section 31 that applies to if there's a low interest loan, less than a market related rate is charged. And there's a bit of a debate whether that trumps section 7.8 of the Act. I think there's a good argument that section 7.8 actually trumps section 31, so that both shouldn't really apply. One hopes that that interpretation is correct, but there's a good argument that 7.8 trumps section 31, but that's not settled in law, so there's a bit of an issue around that. Section 7C can still apply if section 7.8 applies, won't apply if section 31 applies, because there's a specific carve out. You can see it gets pretty complicated. But there is maybe some planning around the denomination of the loan because if it's in hard currency, the rates of interest market related are pretty low, and therefore an arm's length rate can actually still result in very low amounts of interest if one is going to charge interest on the offshore loan. So it's quite a lot to take in. I hope it's given you some considerations regarding the planning, but I'm happy to take questions, Ricardo, if you want to come in at this point.
Thank you, David. I think you have given us quite a good platform from which to have a discussion. There's quite a few questions, actually, David, that have come through. And if there are any others, I can ask you just to go to the Q&A function, and we can then deal with those questions. And we'll do as many as we can today during the session, and if not, we will then reply to them afterwards. So, David, if I can start, we have a question from Toby de Toy. He asks, is there merit in bequeathing your loan account to your family trust instead of to your heirs? Okay, he says that would eliminate section 7C interest issues going forward, and any issues to consider other than the trust deed needs to provide for it.
Yeah, Ricardo, I'd prefer to take, that's a very technical question, and I really would prefer to take that offline. I think it's quite complicated, and yeah, I'd prefer to respond to Toby separately on that one.
Yeah, and I think that's true, because that does impact on the sort of merit of the trust deed. So Toby, we'll get back to you on that question. A question that's come up a couple of times on the Q&A, David, is to do with the primary residence of the donor being housed within a trust. What are the considerations that trustees need to consider in accepting a donation of a primary residence in a home that's going to be sold in time?
Well, I think, firstly, obviously, if it is housed in a trust, one would then lose the benefit of the primary residence exclusion. So I think that's a factor that one should bear in mind, which is 2 million rand. So 2 million rand of any capital gain, in fact, or capital loss in the situation where there's a capital loss, that has got to be disregarded. But that only applies if the primary residence is held in the individual's own name. Okay. So I think that's an important factor, and I think the other one, of course, which mitigates against, as I mentioned a bit earlier, moving pre-existing properties that are already owned in individuals or in other entities into trusts is, of course, the transfer duty that would have to paid in order to get it across into the trust. So often that sort of mitigates against it. If one is looking at purchasing a primary residence, from a third party, one's got to think long and hard about whether one puts that into, whether one puts that into a trust because of the 2 million loss, 2 million of capital gains tax potential loss over time.
Yes, yes. David, would the situation be different? Well, not different. With a donor, would section 7.5 of the attribution rules apply with the primary residence?
Well, there's no reason why section 7.5 couldn't apply. But I mean, if it's a primary residence and the income is retained in the trust, there would generally not be income, you see, with regard to a primary residence, unless, well, if part of the residence was being let out or something like that, then it could apply. But then that would also have to be, that part would have to be subtracted when calculating the primary residence exclusion as well. So that, that one wouldn't qualify for that if one had held that asset in your own hands.
Yeah, correct. Yeah, good. No, I think because that often comes up, the question around the primary residence. I think it is something that is very particular to one's family wealth creation and needs to be considered with its own merit. If we can move on, David, there was questions around case study 1 and 2. You referred to the donor, and the question, there's two questions that have been posed, is if the donor dies or has died and there's a capital gain retained in the trust, what would the situation be in those scenarios?
Well, it's until the death of that person that that Section 7.5 would apply. So in fact, after death, there's no further attribution that then takes place. So then basically the income is then taxed where it lies, as it were, with the South African trust, from perspective. Yeah.
Correct. So the tax is treated within the hands of the trust. Okay.
Yes.
Question around Section 7. Sorry, David, go ahead.
Rather, just I think to add that when it, insofar as the foreign, the non-resident child was concerned in that example, then the tax consequences could still be then taxed in the trust on the basis that that the trust had made a settlement to that person. So, in that case, it could be seen the South African trust had made the settlement with it, so it could be housed in the trust.
All right, thank you for clarifying, David. Looking at a question from Richard King, would a loan account which arises from undrawn vested income be subject to Section 7C?
Sorry, do you mind repeating that, Ricardo?
Sure, Richard. Yeah, so the question is, would a loan account which arises from undrawn vested income be subject to Section 7C?
Yeah, it's a question that has that there are differing opinions on. It's quite a contentious question in a way.
Yeah, that's right.
I think if it is clear that the beneficiary, well, this is one argument anyway. If it's clear that the beneficiary, to whom that amount is being distributed, isn't able to actually call for the amount yet, as it were. So in other words, if the actual payment of the amount out is at the discretion of the trustees, then there's an argument that it doesn't give rise to Section 7C.
Okay.
But as I say, it is quite a contentious question.
Okay, all right. So we'd need a bit more sort of facts around the scenario itself before answering.
Yes.
David, with regard to sticking with Section 7C, question from Mona: what interest rate does SARS use to determine if donations tax is payable? And for example, she says if the prevailing interest rates are 5%, and that is what we have set out as the interest on the loan, and the interest rates are now moving to 9%, would I have to increase the interest on loan to 9%? Goodness, maybe I've... Yeah, so I think the question really is, it's a long-winded question, but I think it's really around the fact that actually what would that interest rate be when there's movement in interest rates between the SARS and the trustees?
Yeah, interest, it's not only based on the loan outstanding at the end of the year. Okay. I think that's a common misconception that you only, you take the loan as at the end of the year, or you take the average movement between the start and the end of the year. It's actually supposed to be determined on a daily basis, on a simple basis, simple interest basis. It doesn't compound, but calculated daily. So the question is, what is the official rate of interest? Because it's the shortfall between the rate that's actually charged and the official rate. If what's charged is actually more than the official rate, then 7C doesn't apply. But it's only if there's a shortfall between the rate that's actually charged and the official rate, and the official rate moves up and down with basically with the repo rate. So one's got to, there are quite, onerous in a way, sort of calculations that do need to be done on an ongoing basis during the year, depending on the movement in market-related interest rates.
Okay, all right. So it's not fixed at a point in time.
No.
Thank you. Thank you, David. There's a number of questions which we have received. So if I can, I think we'll take it offline. From here, David and I will look at the questions and we will reply and circulate those to everyone. So David, if I can, thank you for your time today. Thank you for sharing the insights and practical experiences that you have got.
Sure.
If Londi, if we can move forward then, I think just looking ahead, I'd just like to thank you all for joining today's conversation. The webinar was recorded and a link to this recording will be shared with you. Our final edition of Talking Trust will be hosted on 23 July, that's at 2:30 p.m. And we end this series by bringing all the topics together and into perspective. And so the final topic is trust administration separates a valid trust from an alter ego. It's common that family trust is by its very nature an intimate part of the financial and personal lives of a family. But what we have experienced in practice is that trustees often lose sight of the fact that the trust represented by the trustees is separate from the family. Proper management and administration of the trust on behalf of the beneficiaries is essential to ensuring that the trust remains valid and offers the benefits that were intended when it was first established. So if you have not already, please do RSVP to join us on 23 July as we wrap up the series of Talking Trust with a focus on trust administration. In the interim, if you have any questions relating to the administration of trusts, please do reach out to BDO so that we can help you get to the right solutions and processes. Stay well, stay safe till we connect again. Goodbye.